Hi, I'm Katie at Clic Accounting, and as I mentioned, with my lovely co-director Leanne here. And we are going to talk to you, lovely ladies of Women in Business, how to be more profitable. Clic are experts in helping high growth entrepreneurs take their business to the next level by providing the best accounting, day-to-day bookkeeping and business development support. We are an exciting online accountancy practice, managing a portfolio of clients in the arts, digital media, publishing and business development fields, with combined turnover in excess of 25 million. Our clients are owner-managed businesses. We are an owner-managed business, and we understand the hard work, the constant pedal push, the pain points of business, and we are here to hold your hand through it all. This evening we're going to talk about some easy ways to reduce your, reduce your expenses and maximise capacity, maximise your income, and how to read and understand your financial reports. So let's start by looking at what you're spending. Increasing profit is about much more than just increasing your turnover. Unnecessary expenses can all too often swallow up huge chunks of your profit, so you need to keep a close eye on them. If you're outsourcing, using a consultant, a freelancer, somebody for content writing, whatever, for your business, you need to look at if the service that you're paying for is as productive as it was in the beginning. Have you thought about or reviewed those fees since you started spending in those areas? Advertising, for example, you might be paying a monthly fee, but is it actually working for you? Are you getting great quality leads from this source, or do you find you're getting more clients by referral, for example? Cut the spend if it's not working for you. Are there expenses that you could cut out of your P&L that you wouldn't really notice? If the expense wouldn't buckle part of your business function, if you didn't spend it, you probably shouldn't be spending it at all. And finally, negotiating prices with current suppliers is something that none of us make time for, but we should definitely make time. A top tip here that we find as a business is to block a day out of our diary at least once every year to do exactly this. You do it, have your VA do it, whatever method you use, block out the time, use comparison software or websites, block out the time and review what you're spending money on and how it's working for you. At Clic, at our company, we do this on a monthly basis for our own business and for all of our clients too. So it's just part of the process for us, always looking at what we're spending and how much things are costing us and if we can save money. Now, if we think about best ways to maximise capacity, one of the easiest ways to work out if you should outsource is to work out how much your charge out rate is. Sorry, I'm losing my train of thought. Sorry, ladies, I've got too many screens going on. So work out your hourly charge out rate and then ask yourself then, could I outsource this? So, and pay less than my hourly charge out rate and thus freeing up my time to do more revenue generating work. So for example, if you're a hypnotherapist spending 2 hours a week on your bookkeeping, could you outsource those hours for £30 an hour and instead open up 2 client slots at £100 an hour? It's a no-brainer. Make sure everyone in your business is working to the level of their pay, including yourself. Don't have your top colorist sweeping hair. Don't have your sales manager typing up dictations. Make sure any revenue generating staff are always performing revenue generating tasks. Now, processes are king. If you want to run a slick business done exactly the way you want it, write a process for everything. This sounds like an arduous task to start, but next time you do anything you'd want to hand over to a future employee or your VA, Write the step-by-step process as you undertake the task. It's so much easier to outsource or hand over tasks down the line when you've written a process for it. If there are detailed instructions for the next person to pick up, you ensure quality, consistency, and they'll waste no time umming and ahhing what to do and asking you questions. This is perfect for when a staff member changes roles, leaves, or you outsource. And what about maximising your income? So new clients are great and all, but they can often cost you quite a bit in the beginning. We know this all too well in our own business. Existing clients, however, have huge potential to grow with you and thus grow your income. There are nice ways to tell your existing clients that you'll be raising fees. We like to use humanity and appeal to their human nature. Have a conversation, not a surprise email, for instance. Give them notice, and if they value you, they'll stick with you. If they don't stick with you, it's okay. You'll open up your capacity to the opportunity of a new client paying your increased fees. And see opportunities for when a client needs more and guide them there. It's all in your relationship and language with your client. We can totally help you with that. Can I give you a quote? Let me take care of that for you. I'll let you know how long it's going to take. I'll give you a quote. Guide them there, hold their hand, and you can upsell in a very human way to your existing clients. Upsell gently, I would always say. So at Clic, we've even reduced fees and increased our service for some of our clients hit hardest by the pandemic. And we find our method with our business is to water their grass. So by supporting our clients, we're showing them loyalty and paying it forward. They'll appreciate it, they'll rave about how great you are and recommend you to their friends and associates. So less time and money spent on cold sales leads. I'm going to hand over to Leanne now. I'm sorry if that was a bit waffly. I'm going to hand over to Leanne now, who's going to explain to you a bit about how to read and understand your financial reports. You're on mute, Leanne.
Typical. Sorry. We wanted to talk about reading financial reports because we know that owner managers are often reluctant to look at their financial data, and we think that's because of a bit of a combination of things. Firstly, owner managers know their businesses inside out and very intuitively make decisions. So there's a gut instinct that they run on, and they don't need necessarily to check the data all the time to make those decisions. The other thing is that they're just time poor. So for carving out time to look at financial data just doesn't come to the top of the list quickly enough. And then the last thing is that it's just not very exciting, is it, to look at your financial data necessarily. So this combination leads to ending up just not ever doing it. And then it can actually kind of slow down that decision-making process because you have that gut instinct. You think you know what you need to do, maybe where to spend money, when to make a new hire, but you haven't got the facts to back that up. So it can kind of stifle decision-making a little bit. So we wanted to look at that and hopefully just guide you through some of the key reports that you might see, and a lot of this you might know, and it might just give you a few little hints and tips looking at this data. So the first one that we're going to have a look at is the profit and loss report. So I'm sure you will have all seen a profit and loss report. This one on the screen is from the accounting software that we love, which is Xero. And we really champion this software. It's easy to use, very accessible, affordable. And this is a very simple layout, if you like, for a profit and loss account with sales at the top, just a one-liner there for sales. You can put as much or as little detail in these reports as is useful to you and your business. So if you've got a bronze, silver and gold package, you might want to see those 3 lines under that turnover section. Or if you've got 3 shop locations, it might actually be better off having 3 separate columns and mini P&Ls for each of those locations and the costs associated with them. So turnover always sits at the top, and the next one down is your cost of sales. And again, it's just a one-liner here, purchases, but cost of sales should be anything that directly fluctuates with your turnover. So if you are a nursery, let's say, for a childcare provider for young nursery age children, the number of staff that you'll have in a week and the amount of food that you buy will fluctuate directly with the number of children you've got in. It will go up and down with the sales. Whereas if we look a bit further down under administrative costs, the fees don't move when the turnover moves. You've still got to pay your rent. You've still got to pay your telephone bill, regardless of any children being in that week. So the cost of sales are those direct costs. Sometimes they're called direct costs or costs of sales, will sit in their own section. And underneath that, you've got your gross profit. So that's just one minus the other. Turnover minus cost of sales, and it will be shown numerically, but a very useful number to track as a percentage of turnover, a gross profit percentage, because that will really give you an insight as to whether or not your costs are going up at a faster rate than your turnover, where you might be overspending. In a period of growth, that might be the right thing. You might have to throw some more resources at getting that growth, but a really useful number to track, and one of those that you can just look at very quickly, month on month. How is our gross profit percentage? At this point last year, what was our gross profit percentage? So the administrative costs always sit under that gross profit line, and that's everything else. And that, again, that might be called overheads, administrative costs, expenses, whatever it's labelled. That's everything else that you have to spend, really, regardless of if you turn over a penny in that period. I would recommend reviewing the profit and loss monthly and looking at it this month compared with the previous 5 months, so that you're looking at least a 6-month period, but also always tracking on a longer term basis. So maybe your year to date or a rolling 12 months compared with the previous year. Again, it can be quite an easy way to spot an anomaly, or where you're overspending, or where something has cost you more than you would expect. So after you've taken the turnover less the cost of sales, less the administrative costs, that's where we come down to our operating profit. And this is the normal profit that you make from your operations. There's nothing on this report that then sits under that, but if you had a non-operating expense, that would then come below that line. And by that I mean something not in the normal running of the business. So that might be if you had to fight an insurance company for an insurance payout and you had legal fees, that wouldn't be in the normal running of your nursery business. So that would be after the operating profit line. The profit on ordinary activities before taxation, profit before tax, exactly what it says. And we would always recommend small businesses track their taxation throughout the year. And that's for a couple of reasons. One is so you don't get a nasty shock when it comes to the tax bill, and you can start to plan for that bill when it becomes due. You can feed it into your cash flow plan, make sure you've got the money tucked aside. And the second reason is that if you're operating a limited company, the amount that you can pay yourself out of profit is after tax. And it's a very easy trap to fall into, that you think, I've made this much profit, I can safely draw this much this month, without having factored in the chunk that you're going to have to give to the tax man. So dividends are always paid out of post-tax profit, so really vital that you track that number. So that's the profit and loss account. There's a few slides, Katie, with little highlights on, so you might want to just tap through those. Yeah,
I'm so sorry.
That's all right. And then
oh my god, I'm all over the place. Okay,
that's it. Yeah. So the other report that you'll often be sent or, you know, be aware of as part of your management accounts is the balance sheet. And this is the company's or the business's health check, if you like. And rather than covering a period of time, so you won't be looking at a month or a quarter here, you're looking at a point in time, a snapshot on the balance sheet at a point in time. And if we thought about our own balance sheet personally, you would have your house as an asset and your car as an asset and your stocks and shares ISA, and then you might have your mortgage reduced, you know, as a liability, your car loan, for example, and a credit card. And those assets less those liabilities is what gives you your financial health, your wealth, if you like. And that's all that a balance sheet does for a business. So at the top here, we've got tangible assets. So these are the physical things that you own in the business. Computer equipment, you might have plant and machinery, any vehicles. But up here, you would also have, if you've bought goodwill or purchased a franchise or anything like that, you'd have the intangible assets up in that top section as well. The next one down is the current assets. So there is the cash, but also any assets that could be turned into cash quickly, normally within a year. So that's why the accounts receivable, also known as trade debtors, money that you're owed from your customers, would sit in that current assets section. The creditors is the accounts payable, anything else that's going to be paid out that the business owes out within a year. So again, you might have your PAYE bill in there, your corporation tax bill. We've got VAT on there as well. Any liabilities that are due within a year. And there are no non-current liabilities on this example report, but you might have a longer term loan, for example, with the bounce back loans, that they would be split between the amount that you're due to pay within 1 year and then a longer term liability beyond 1 year would sit separately. And you'll see on a balance sheet that all of the assets, so the fixed assets and the current assets, less the creditors and the long-term liabilities, gives you a net assets figure. So on here, we've got a total assets less current liabilities. So that's everything totted up with the fixed assets included, gives you this net assets figure. So this is what's left, if you like. And if this is a positive figure, it shows that the business has the assets that it needs to cover its liabilities. If this is a negative figure, it signals a problem that action needs to be taken. So that might mean that too much drawing has been made against profit, or it could signal some other problems. So if this is a negative figure, then action needs to be taken. And you'll notice if you scroll down slightly, Katie, that the reason it's called a balance sheet is because this top half, even though it takes up a lot more of the page, is that it totals the same as this bottom half here, the capital and reserves. The 9901 is at the top of the bottom. A balance sheet will always balance. And what the bottom half is doing is it's showing how those assets have been made up over time, or how that net assets figure has been made up over time. So it's the current year earnings, but it's also all of the earnings from previous years up to this point that haven't yet been drawn out. In this example here, the retained earnings, so the brought forward position, was actually a negative figure. So the two together net off to make the 9901. And that's all a balance sheet's doing. And we know that sometimes it can be a bit of a report where people switch off and don't really look and think, oh, that's for the accountant, so I won't worry about that. But it's a good report to keep an eye on. And if your books and records are in good order and up to date, looking at these two reports, and in the book we talk about the 3 key numbers that we think all business owners should look at regularly. It should be a really simple task to be able to look at the financial health of your business and review those numbers quickly and easily without having to, spend hours and hours sifting through financial data. And that's it. That's the two kind of reports that we wanted to talk you through.
Yeah, the ones that people avoid looking at in their year-end accounts, I think, and go straight to the corporation tax liability. We all want to know what we're going to owe, but it's actually really good to know, especially if you're planning to grow and expand your business. It's really good to understand those reports. So I think, to summarise what we've waffled on about, really quite a boring subject. We know accounting is, being quite a boring subject, but it can be really, really insightful to know how your business is doing. And we'd say, top tip for that really is to review it all the time. Have a look. Don't avoid looking at the numbers. If you don't understand it, ask. Don't be afraid to ask your accountant or your bookkeeper to explain something to you that you don't understand. You should understand it. It's your business, and that's part of our job, is to work with our clients to make sure that they do have a really good idea of how the business is doing right now and the direction they want to take it in. So I'd say carve out time to review it regularly, and as far as profit's concerned, I don't need to explain the ethos behind Women in Business Network. It's creating relationships, lasting relationships, and referrals. That can be your strongest point of profit increase in your business.